Gold in an uncertain world. In recent weeks, global markets have once again been reminded how quickly the geopolitical landscape can shift. Rising tensions in the Middle East, particularly surrounding Iran, have created renewed uncertainty across energy markets, currencies, and equities. In periods like these, investors inevitably ask a simple but important question. Where should capital be positioned when the global environment becomes less predictable? History provides a consistent answer. When geopolitical risk increases, capital tends to migrate towards stability. For centuries, one asset has repeatedly stood at the center of that movement: gold. Gold occupies a unique position in the financial system. Unlike equities, its value is not dependent on corporate earnings. Unlike currencies, it is not tied to the fiscal strength of a single nation. It is recognized globally as a store of value, one that sits outside the direct influence of monetary policy or sovereign debt cycles. This is why, during periods of geopolitical stress, gold often re-emerges as a strategic asset for serious investors. But the investment case for gold extends far beyond short-term headlines. There are several structural factors that continue to underpin long-term demand. First, global monetary expansion. Central banks around the world continue to increase money supply and, increasingly, accumulate gold reserves as a hedge against currency volatility. Second, inflation protection. Periods of geopolitical tension often disrupt energy markets and supply chains, creating upward pressure on costs across economies. Historically, gold has served as a hedge during these inflationary periods. And third, diversification. Institutional investors allocate to gold because it behaves differently from traditional financial assets, helping stabilize portfolios during times of market volatility. However, it is important to recognize that there is a meaningful distinction between simply owning gold and investing in the gold sector. Many investors gain exposure through bullion or exchange-traded products. While these can track gold prices, they do not capture the broader value creation in the industry. Participating directly in gold development and production projects allows investors to benefit not only from the underlying commodity price, but also from the value generated through resource development and production economics. In other words, investors gain exposure to both the asset itself and the opportunities surrounding it. In today's world, where geopolitical tensions, shifting alliances, and economic uncertainty are becoming increasingly common, tangible assets are regaining their importance within serious investment portfolios. Gold has played that stabilizing role for thousands of years. What we are witnessing today is simply a continuation of that enduring reality. Oakmount and Partners, delivering stability in uncertain times.